the Real Retirement Podcast. We took a hiatus and now we are back in action. I'm joined by my colleague Matt Higbie, who is also a CFA and CFP. Today we'll be talking about overrated tax strategies. Matt, what do we mean by that?
Yeah, overrated tax strategies are the ones that get the most headlines from the main financial media, but are always pitched as no-brainers for everyone that's at a certain level of net worth. And our simple perspective is that they're not no-brainers, and oftentimes they're not often what's best for the client.
And then we will close with a strategy that we think does work pretty well. All right, so let's jump in here, Matt. What is the one thing that no one likes paying a whole lot of?
Speeding tickets.
Yeah, okay.
But also taxes.
Okay, that is very true on both accounts. Yes, taxes are something that we definitely do not like paying, and especially we don't like paying them if they add complexity to our situation. And we feel like these overrated tax strategies kind of do that. They maybe save you a little bit of taxes, but mainly they're adding complexity to your situation. So I wanted to read an article or a snippet from an article this came out a few weeks ago from Barron's. It's called New Ways to Minimize Taxes on Your Investments and Why It's Especially Important Now. So there's four of them, and we'll kind of talk about them. Or actually, there's only three of them. It's direct indexing.
Yes.
Making a customize your portfolio to decrease your tax hit. And then thirdly, going long and short, building a long-short portfolio. So first off, the article talks about a certain company. There's obviously lots of asset managers that provide direct indexed products. This one in particularly rhymes with Fidelity. And what it says is that their direct index product holds 396 individual large, mid, and small cap stocks in each client's account instead of a total market index ETF. And they continually harvest any capital losses on individual stocks throughout the year. Now here's the benefit of doing that, Matt. The losses it generates can actually exceed the gains of the direct index account and can be used to counteract taxable gains in other parts of the portfolio. And it can be written off against an investor's taxable income up to $3,000 annually. So that's the benefit right there of having a direct index strategy. You can harvest losses, so sell a position, an individual position at a loss, and use it to offset gains. So what's our hot take on direct indexing, Matt? Is it all that it's cracked up to be?
Yeah, I think there's a few nuances to keep in mind here. And the first one is that the fees associated with products like this one are often going to be much higher than simply owning the underlying index. So today for an S&P 500 ETF, for example, you're going to pay 3 to 5 basis points. But for most of the direct indexing products, which would also track the same index, you're going to be paying 40 bips or more in some cases. And so the fee rate as a starting point is much higher, and that's certain. The tax losses are potential and hypothetical, but the fee rate is certain. So there's a higher cost that needs to be kept in perspective here. And the second thing is there's a shelf life to the losses. Since the market goes up over time, the losses tend to plateau after the first few years, but the fees keep going up. Because if it's a 40 bips fee rate and the assets keep going up, the fee in dollar terms keep going up, but eventually you burn out all the losses, and the fees can more than offset the tax benefits. And then the last point is just to keep in mind that the taxes that you're realizing, or the losses that you're realizing to offset current taxes, are only being deferred into the future. So if you lower your basis today by taking losses, the eventual gain on selling the account or liquidating the account is going to be higher in the future. So it's a deferral strategy, which can be valuable in certain circumstances, but the losses or the gains on this account will have to be realized at some point.
Yeah. And then the other thing I think that we run across too is that you end up holding lots of positions that maybe aren't as good, or maybe not something that you want to hold long term, because you're basically selling whatever stock or company had a loss during the year. So that could be maybe a really good company that just kind of had a stumbling block at one point during the year, and you sell it. and then you never hold that company again. So you miss all the upside of that company as well. There was a kind of a good article that was written by the FPA, and it was titled "Direct Indexing and the Diet of Distraction." I like that title. And kind of the subheading is "A Solution in Search of a Problem," which, quite frankly, is kind of what we see a lot, Matt, in portfolios. Is that sometimes we're just trying to make things more and more complex to, I don't know, justify ourselves, justify the finance industry, whatever the case may be. And direct indexing, at least according to this article, and maybe similar to how we're thinking, it just might be a solution in search of a problem. So here, I'll read from this article. It says, direct indexing is only one of many products marketed as innovation to meet mostly imaginary needs. I thought that quote was kind of
pretty harsh.
Kind of interests me. Yeah, pretty harsh. But this is becoming big business, direct indexing. It says, according to Fidelity's 2024 RIA benchmarking study, 50% of registered investment advisors, RIAs, with assets exceeding $1 billion are currently offering or planning to offer direct indexing to clients. So, in other means, if you have money and you're working with a large RIA or someone with significant assets, more likely than not, this is going to come your way. We just want you to be aware of what's out there and what it really means. All right, the next piece of fancy strategies in order to reduce taxes is taking your portfolio another step further and customizing it. So this was from back to the original article, and it says that BlackRock has acquired one of the largest indexers, Aperio. And Aperio is a direct index strategy, but they're also adding in different things in well. So they can incorporate value indexes, foreign stocks, small cap stocks, and bonds into a direct indexing strategy. So it's not just the S&P 500, the 500 companies, but now it's basically any market around the globe you can be a direct indexer in. And the issue I find with this, and Matt, curious if you have any other additional thoughts, is that basically it doesn't solve the initial problem. The initial problem is that you're holding things that may or may not be the position that you want to hold long term, and now you're just multiplying it into different markets. Just beyond the S&P. So now you're holding stuff internationally that maybe you don't want to own over the long term after you've harvested these losses. Now you're owning bonds that maybe aren't the best, and it's just, again, adding more things to a portfolio that may or may not need to be there.
Yeah, the issue is the losses burn out after the first 4 or 5 years, which data from Vanguard and others has shown historically to be true. And the problem of the losses burning off is not solved by adding more complexity and diversifying into asset classes that you might not otherwise want to own. So I'm with you on this one.
Yeah. Okay, and then the last one, the third strategy that gets touted as a panacea for high net worth investors is to go long short. And what this is, and Matt, you're in this space, or we're in this space way more than probably anyone else here. But what it is you take a position where you're 130% long, and I'll talk about, or maybe you can touch on how exactly you do that. How do you own something more than 100%? 130% long, and then 30% short. That's how the portfolio bit. So net, you're 100%. You own the market, but can you kind of describe what that setup is?
Yeah. So think about it as putting in $100 of capital. So you're saying, I want to buy $100 of stocks. You then borrow another $30. So you effectively own $130 of stocks, but then you also short $30 of stocks. So the extra 30 long that you're borrowing to create the extra 30 of exposure is offset in a net terms by the 30 of short. So your net exposure is only 100. So your performance in theory should be similar to the underlying index into which you put $100. But as someone who has done a lot of long short investing and tried to keep things very tight with portfolio construction, I know that there's a lot of ways that this can go bad. And so I'm kind of stumped on this one. It's something I've been researching and diving into, but I just can't for the life of me understand how this doesn't either lead to worse performance because the asset manager who's making the trades and making the calls on trying to beat the market doesn't do their job, or just even more deferred capital gains that get bigger and bigger as you're harvesting more and more losses. I have a hard time seeing how one of those two things isn't true, which is not to say this is never a good fit for anyone, but is not something I've been feeling compelled to put my own money into, and therefore wouldn't want any Birchwood clients in either.
Yeah. And the thing that we have to remind ourselves with leverage is that with leverage, and another way of saying leverage is borrowing, so you're borrowing money, you're taking a loan out to buy more stuff, is that it increases the upside, but then it also increases the downside. So with leverage, you're basically adding more risk to your portfolio. And again, some people maybe want to take that risk or understand the risk that's out there by implementing a portfolio like this. But from what we see typically is that, again, it's just something that's added because it sounds fancy and makes things more and more complex than what they really should be.
And one other thing to say, Stephen, to your point on the added risk of a strategy like this is, unlike owning a stock where the maximum loss is 100%, because any stock you buy can go to zero, at which point you've lost your investment, a short can actually, in theory and in sometimes practice, it's come close, have infinite losses. Because if you short something at 100 and it goes to 1,000 or 10,000 or 100,000, you've lost multiples of the money that you put into the strategy. So the asymmetric risk associated with shorting instead of owning things outright is another complicating factor here that I can't quite get on board with.
Yeah. Advisors, asset managers, we have to justify our existence somehow. So a lot of the times what it comes out is pushing ideas and products just to, again, give us something, fancy to do. And the question that I always fall back on is, hey, is this really helping? Is this really solving the issue that needs to be solved? And if so, then absolutely, let's do that. We obviously want to solve issues and problems for clients. But if it's not, if it's just adding, complexity and more paperwork and that sort of thing, then maybe that's something that we take a second look at. We're just kind of wary of separately managed accounts, SMAs, direct indexing, all that stuff, because most of our clients are trying to move away from that. They want something more simplified. All right. So lastly, I just wanted to share quickly about a tax strategy that we think does work, that actually does offset taxes in a real way. There's a catch to it, but I think it's an important catch, and it can be really beneficial to those that use it. So this is combining a donor-advised fund, so making a donation to a donor-advised fund, and a Roth conversion. So some of those topics we'll probably make a couple more videos about, exactly diving deep into donor-advised fund and Roth conversions and all that good stuff. But for the most part, what we're doing is taking a deduction by donating an appreciated stock to charity, and then using that deduction to do a conversion that basically eats up that deduction. So it's a way to convert money into Roth. So I'm taking pre-tax money, converting it into Roth, after-tax money, it's never taxed again, and paying for that with a donor-advised fund contribution. That's the idea. Of course, the catch, though, Matt, is that you have to be charitably inclined. So you have to be willing to part with some dough in order for the greater good and to support some causes that you really care about. Which can, this will be another podcast or another show where we'll talk about kind of the benefits of generosity and how that actually can really free you from trying to hold tight to your money. But that aside, you have to be willing to give money to charity in order for this strategy to work.
Yeah, if you weren't planning on giving the money away, it's a very expensive way to reduce your taxes by a little bit. But for anyone who was planning on giving and or gives regularly, this is a great way to save on taxes.
Yeah. So utilizing the donor advised fund and Roth conversion strategy together, I think makes a very good match. Well, Matt, this was a lot of fun. Thanks for helping me out here.
I love it.
And talking about some overrated tax strategies, and then maybe one that I think could help out a lot of folks. All right, we'll see you next time.
If you're curious about where you stand in retirement and how exactly you can avoid paying too much in taxes to Uncle Sam, head on over to birchwoodcapital.com. I also have additional posts on retirement and an easy way to get in touch if you have questions or to offer any feedback. I hope you keep enjoying these podcasts no matter where you are in the road to retirement.
And lastly, let's keep the lawyers happy. This episode is for informational and entertainment purposes only and should not be relied upon for any investment or financial decisions. This isn't tax, legal, or investment advice, as I don't know your unique situation. I'm the president of Birchwood Capital, a registered investment advisor in California. Myself and clients of Birchwood Capital may maintain positions in securities discussed in this podcast.